Thank you for joining us today. My name is Isao Ogata, President and Representative Director of Raccoon Holdings, Inc. Today, I would like to walk you through the new midterm management plan. Let's start with the executive summary. The key point of the new MTMP is our business alliance with Advantage Partners to accelerate our growth and realize the Raccoon B2B network. In light of this, we have decided to revise the midterm management plan announced last year. Our updated strategy focuses on accelerating the growth of existing businesses through strengthened sales and marketing and more rigorous KPI management, while simultaneously creating new services via strategic M&A and alliances to meet customer needs more broadly and deeply. Second, we are focusing on our group management policy, which corresponds to our long-term vision. By pulling our base of roughly 600,000 transacting customers under the Raccoon B2B network concept, we will seamlessly drive cross-selling efforts to increase the value of transactions per customer and ultimately maximize LTV. Third, to execute the business strategy for this midterm management plan, we will leverage Advantage Partners' knowledge and experience as a priority measure and accelerate the growth of existing services by flexibly implementing sales and marketing measures, with KPI management for metrics like ROE and ROI. In parallel, we will create new services that will serve as pillars of growth by clarifying target areas and actively pursuing M&A and alliances. Based on these revisions, we project 7.5 billion yen in net sales for fiscal year 2027, scaling to 10.3 billion yen by fiscal year 2029, for a CAGR of 16.1%. We're also targeting 600 million yen in operating income for fiscal year 2027, growing to 2 billion yen for fiscal year 2029, for a CAGR of 14.8%. On the operating margin front, we are guiding for 8% for fiscal year 2027 and 19.4% for fiscal year 2029. Lastly, we project 1.05 billion yen in adjusted EBITDA for fiscal year 2027 and 2.45 billion yen for fiscal year 2029, for a CAGR of 15.4%, with adjusted EBITDA margin targets of 14% and 23.8% respectively. As Mr. Konno noted earlier, in line with the revisions to our midterm plan, we anticipate a temporary drop in margins due to upfront investments. Our decision to raise promotion investment levels is backed by two main factors. First, our business alliance with Advantage Partners, which brings granular and sophisticated KPI management, and revamped internal meeting structures to drive our company-wide strategy. The second factor is the highly successful pilot tests we ran in the fourth quarter of fiscal year 2026. Based on the results of those pilot tests, we will raise our advertising and marketing spend. We expect this to result in a temporary profit decline in fiscal year 2027 as these costs precede net sales generation. That said, as net sales growth accelerates due to the effects of these investments, profit is expected to recover and expand starting in fiscal year 2028. Through these initiatives, our plan targets a 14.1% net sales growth rate in fiscal year 2027 and aims for a 16.1% CAGR by fiscal year 2029. To give you a bit more color on those pilot tests, we ran them across each business for 2 months, from February to March 2026. We allocated 40 million yen to Super Delivery, 5.6 million yen to Paid, and 5.7 million yen to Uriho to test the cost-effectiveness of additional advertising. For Paid and Uriho, we also brought in outsourced sales teams to secure more business discussions. For Uriho specifically, we simultaneously ran a campaign offering higher referral fees to our regional bank partners. The results were highly encouraging. Super Delivery saw a 33.4% increase in new memberships. Paid achieved an increase of approximately 50% in the number of business discussions secured, and Uriho recorded a 26.3% rise in new memberships in April. Based on these numbers, we will move forward with our growth investments in fiscal year 2027. Allow me to direct your attention to the diagram. Looking at our actions for fiscal year 2027, the focus is clear. Grow existing services, increase group services, and promote group customer conversion and drive cross-selling. This ties directly into the core theme of the new midterm plan, which is laying the foundation and implementing the B2B network concept for early realization through our alliance with Advantage Partners Company Limited. By unlocking cross-selling across our shared customer base, we expect the B2B network to drive exponential growth in our overall business scale by fiscal year 2031. We have structured our priority measures around two pillars: our group strategy and the strategies of each business. Under the group strategy, we will lay the foundation for group customer conversion by integrating customer databases across services. We will drive cross-selling by designing incentives for multi-service use, such as offering special plans and awarding points. We will also create a mechanism for expanding transactions using credit limits, evolving from simple one-to-one interactions into dynamic many-to-many trading. Turning to the strategies of each business, we will accelerate the growth of existing services while simultaneously creating new services through M&A and investments. Concurrently, we are proactively building relationships with the startup industry through collaboration with VCs to cultivate our future customer base. This past February, we announced our future vision for the group in fiscal year 2031. Once the Raccoon B2B network is fully realized, we target 13.5 billion yen in net sales with a 15% CAGR, 4.4 billion yen in adjusted EBITDA with a 33% margin, and 4 billion yen in operating income with a 30% margin. Ultimately, we aim for a share price of 1,800 yen and a market capitalization of approximately 50 billion yen. Next, I'd like to take a step back and briefly review the fundamental purpose of the Raccoon Group. Allow me to briefly outline the significance of the Raccoon Group's existence. The vast majority of our customers are small and medium-sized enterprises that face the clear challenge of labor shortages and limited management resources. We utilize our proprietary technology, primarily in the field of IT, to provide systems our customers could never build on their own. By streamlining their operations, we embody our corporate philosophy, making corporate activities more efficient and convenient. To give you an example of what the world looked like before our services, retail buyers often had to close up shop for an entire day just to attend exhibitions and visit wholesalers to stock their inventory. Today, Super Delivery enables these owners to conduct wholesale transactions online without ever leaving their stores. What's more, when it comes to payments, strict conditions such as advance payment were once the norm. In fact, there was a time when physically carrying cash to wholesalers was standard business practice. Today, Paid enables deferred payment. Because it provides combined credit settlement for multiple companies at once, buyers can settle their accounts in a single lump sum, which drastically simplifies both payment management and transaction fees. Also, looking at the selling side, for manufacturers, for example, the situation was very different before Super Delivery. Many were unable to conduct nationwide sales, meaning they had to rely on a network of regional branch offices or have sales reps physically travel around with samples. Now, simply by listing their products on Super Delivery, orders come in from all over the country, and all they have to do is ship the goods. The same efficiency applies to accounting functions. Because Paid handles everything in a single lump sum, we take on all the hassle even if a payment is slightly late or falls into arrears. Finally, for credit management, Uriho ensures that businesses receive compensation even if a partner happens to go bankrupt. Here's a chronological overview of Raccoon's history. I founded the company in 1993 entirely on my own. In fact, I did not hire our first employee until 2000. For the first 7 years, I ran it as a one-man trading business, making cold call sales visits to roughly 10,000 stores. Experiencing firsthand the manual burden SMEs carry day to day led me to explore how we could digitalize that work to make corporate activities more efficient and convenient. That drive to solve real world problems is the origin of each business infrastructure service we offer today. The very first of these came when we launched an excess inventory sales website in 1998, clearing the surplus stock of larger companies in the aftermath of Japan's economic bubble. We took that excess inventory, broke it into small lots, and sold it as promotional goods to retailers across the country, building a large membership base of small retail stores. Because inventory clearance naturally comes to an end once the stock runs out, we leveraged this customer base, and in 2002, we're finally ready to open our B2B marketplace, Super Delivery, for full price and new products. The trust we had earned during our deep discount period served as our foundation, and the platform came to function much like an online wholesaler for retailers nationwide. Sales grew steadily, and in 2015, we launched our cross-border EC export sales service, Super Delivery International. Recognizing that Super Delivery customers needed a way to pay later, we built an algorithm to facilitate this, with this service starting in 2009 as SD Payment. While we faced initial collection challenges, we acquired a leasing company's subsidiary, took on its credit assessment know-how, and systematized it using AI. This system ultimately evolved into Paid, our current intercompany credit settlement service. Our receivables guarantee service also originated from that same acquisition. While there are many guarantee services that rely on in-person sales, very few specialize in serving micro and small enterprises because traditional in-person sales models are simply not cost-effective for small individual accounts. Since our core customers are SMEs, this is an important dynamic for us. To solve this, we evolved the model into Uriho, a fully online subscription-based receivables guarantee service, which now serves as the core of our receivables guarantee business. Broadly speaking, our operations are divided into two main segments, the EC business and the financial business. The common thread across all our platforms is that we take inefficient tasks once performed by hand and apply IT and other technologies to dramatically reduce the time and costs involved. Specifically, the EC business comprises Super Delivery and Super Delivery International, while the financial business comprises Paid and Uriho. Every one of these services was, we believe, the first of its kind to market, with no precedent at the time. In other words, while there are many similar services today, our fully online receivables guarantee service was also a market first when we launched it. Turning to our scale of business, compared with the fiscal year ended April 2022, Super Delivery's annual buying customers have grown from 44,000 to 66,000 businesses as of the fiscal year ended April 2026, and suppliers have also gone from 3,000 to 3,300 companies. Annual gross merchandise value, or GMV, has risen from 21.6 billion yen to 31 billion yen. Paid's annual value of transactions has grown from 34.7 billion yen to 60.5 billion yen, and Uriho's guarantee balance has expanded from 30.6 billion yen to 76.4 billion yen. Our management resources and core strengths fall broadly into three categories. The first is understanding customers. The business practices of SMEs are highly complex and idiosyncratic. In Japan especially, the customs surrounding SME distribution and settlement are quite distinctive, which likely explains why overseas services have struggled to gain a foothold here. Because we specialized in this space from the very beginning, we possess a deep understanding of customer needs, business practices, and industry knowledge. The second is our power to utilize technology. Right from our founding, we have built everything in-house, accumulating extensive IT expertise in distribution and settlement. The third is our data assets. We conduct credit assessments for our roughly 600,000 group customers, providing them with credit limits and guaranteeing their transactions. Because transactions are constantly taking place on this basis, the resulting data has become a vital proprietary data asset for the Raccoon Group. I would now like to walk you through our group management policy. Within this scope, we are advancing our Raccoon B2B network concept to address the dual challenges SMEs face: limited resources and limited credit. Because of these constraints, small businesses often lack clear procurement channels and are naturally wary of first-time business partners. This is precisely the risk we mitigate. By comprehensively screening our customer base and backing their everyday transactions, we enable even small new companies to trade with each other safely and conveniently within our group. Ultimately, the fundamental purpose of our Raccoon B2B network is to provide diversified services that make our group customers' corporate activities more efficient and convenient. Our network is safe and convenient to use, even for first-time transactions. What's more, as creditworthiness is a cumulative process within the network, even customers with less than perfect histories are incentivized to maintain good standing. This dynamic drives conversion to group customers and enhances the utility of our services. By leveraging Raccoon's credit know-how, even newly established companies and sole proprietors can prove their credit worthiness and achieve secure, smooth completion with paid. Our customer base is heavily concentrated among very small businesses, many of which do not even appear in standard credit research databases. As a result, outside vendors often hesitate to do business with these small companies. Additionally, while our customers conduct transactions on our platforms, their interactions currently remain siloed in one-to-one relationships. By rolling out the Raccoon B2B network to interconnect these user bases, we will enable cross-selling and expand into many-to-many trading, creating the exact mechanism we need to increase the group's value of transactions per customer and maximize LTV. Allow me to direct your attention to the diagram. There are various ways to define our TAM, but we estimate it at roughly 5 million companies in Japan at most, compared to our current base of 600,000. To put this in perspective, while our transactions are predominantly one-to-one today, linking and integrating our customer databases will allow external providers to come forward with targeted service proposals. Given the sheer scale of our network, they could potentially offer volume discounts or highly convenient new services. We will also conduct our own research, reach out proactively, and utilize M&A to increase the number of these new service providers. Ultimately, multiplying our group customers by the value of transactions per customer drives exponential growth, and this formula is the core of the Raccoon B2B network concept. Let's now turn to the summary of our midterm management plan. Our alliance with Advantage Partners will lay the foundation for the early realization of the B2B network. We recognize that partnering with an outside fund can sometimes draw mixed reactions, but we sought this alliance to accelerate our growth strategy. Working through several investment banks, we actively looked for a partner who truly understood our corporate value and could work closely alongside us toward a shared goal. Advantage Partners proved to be the ideal match. They bring a wealth of management resources that we currently lack, which, truth to be told, are exactly the capabilities we need at this specific stage of our growth. While we are incredibly proud of our long tenured staff and frequently praised corporate culture, the reality is that we simply do not have many individuals with the specialized expertise that MBAs or consulting backgrounds bring to the table. Historically, our growth has been driven largely by my own personal experience. With Advantage partners, we will draw on their data analysis capabilities, objective decision making, and proven track record of success. Guided by their advice, we will drive cross selling among group customers and design incentives for multi service use. For our existing services, we will leverage AP's expertise to optimize our marketing, such as agency selection and advertising ROI, to accelerate growth. Building on this foundation, we will also increase group services. Circling back to the targets I touched on earlier, for fiscal year 2029, we project 10.3 billion yen in net sales, representing a CAGR of 16.1%. For operating income, we project 2 billion yen, a CAGR of 14.8%, with an operating margin of 19.4%. We project 2.45 billion yen in adjusted EBITDA for a CAGR of 15.4%, alongside an adjusted EBITDA margin of 23.8% and an ROE target of 25%. Allow me to walk you through our business strategy, starting with the EC segment. Here, net sales break down into fluctuating revenue and fixed revenue. For the fixed portion, while we still charge membership plan fees, the model has evolved. Paying these fees earns points, allowing customers to actively choose between paid and free membership tiers. Fluctuating revenue is calculated by multiplying GMV by our take rate. As Mr. Kono covered earlier, this fiscal year we are prioritizing new member acquisition while sustaining the rise in the value of transactions per customer. While this has always been a focus, we have identified specific areas where higher advertising spend will allow us to directly acquire more customers and expand our base. So these are areas where we want to accelerate our efforts. We position this as our key strategy. To clearly illustrate our value proposition, let's compare the world with and without super delivery, looking at it first from the manufacturer's perspective. For manufacturers who are initially unsure of what or how to sell, utilizing our platform provides immediate clarity by revealing market trends and a continuous accumulation of transaction data. When either the buyer or the seller is a large enterprise, an intermediary is often unnecessary because they possess the scale to manage transactions directly. However, when transactions occur strictly between small-scale buyers and small-scale suppliers, having a trusted intermediary becomes absolutely vital to bridge the gap. For instance, a boutique specialty shop in Shimokitazawa and a wholesaler importing Indian goods could theoretically deal with each other directly. However, because retailers must constantly source fresh merchandise and new suppliers to retain their customers, managing these individual relationships becomes unsustainable. This ongoing need for new product streams is precisely why a centralized digital marketplace is indispensable. While traditional wholesalers relying on physical logistics, brick-and-mortar showrooms, and in-person visits have become obsolete, the intermediary function itself remains crucial, a fact proven by the massive demand we unlocked by digitalizing it. Searching for and managing suppliers individually is highly inefficient, but our platform eliminates this friction by allowing retailers to easily discover and connect with numerous manufacturers in a single marketplace. While physical sales visits limit a buyer to 2 or 3 companies a day, Super Delivery allows retailers to browse dozens of suppliers at their leisure, outside of store hours, while gauging market rates. Crucially, overseas expansion presents an immense challenge for small and medium-sized manufacturers, as it is simply unrealistic for them to exhibit and hand out samples at international trade shows with interpreters and foreign language slide decks. This is precisely where our platform thrives. We already handle a massive volume of international transactions, making cross-border EC a core strength where we truly excel. Moving forward, we aim to support many more small and medium-sized manufacturers in opening shops and expanding overseas, fully resolving the barriers of language, logistics, and contracts. Our plan for super delivery centers on strengthening the customer base. To acquire new customers, we will identify focus categories, refine targeting, and expand database-driven advertising investments. To advance our overseas localization strategy, we will tailor our approach in key target markets by prominently featuring tariff details and region-specific bestsellers. We will also strengthen our customer interfaces to elevate the value of transactions per customer, utilizing data analytics to execute proactive outreach and tailored proposals through all our touchpoints, including visits, calls, and emails. We will support new shop launches, continuously improve product searchability and UX, and enhance supplier-facing functionality. Furthermore, to build out our wholesale infrastructure, we announced SD Direct today, which opens up our order processing and settlement infrastructure to fully digitalize the traditional analog orders that super delivery participating companies receive from their existing business partners. For super delivery on a standalone basis, we project 48.65 billion yen in GMV for fiscal year 2029, representing a CAGR of 16.2%. Of this, we expect domestic GMV to account for 35.41 billion yen at a 15.8% CAGR, and international GMV to account for 13.24 billion yen at a 17.5% CAGR. We are targeting 60,588 buying customers, an increase of 15.7%, and 226,480 yen in value of transactions per customer, up 1.1%. Let's now cover the financial business. Net sales are calculated by multiplying transaction volume by the guarantee rate, with transaction volume driven by the number of member companies multiplied by the value of transactions per company. Expanding this member company base remains our primary strategic focus. Without paid, credit risk and collection concerns severely restrict B2B trading expansion, especially with micro enterprises, leading many companies to turn away small businesses entirely. Paid allows these companies to transact securely while completely removing the burden of billing operations, which is a notorious structural challenge for SMEs. I speak from personal experience here. When a smaller counterpart asks to push a payment to the next month, it creates real shipping uncertainties, because you simply don't know if you should release their pending orders. At the same time, if you call them and press the issue, you risk straining a valuable customer relationship, which is why we resolve this friction entirely by stepping in as a neutral third party. Historically, domestic SMEs primarily transacted with local partners, but the rise of e-commerce has brought an influx of orders from distant, completely unknown parties. In today's fast-paced environment, taking the time to meet face-to-face or build trust gradually simply isn't an option. Consequently, relying on traditional gut instinct and experience to extend credit to total strangers is no longer realistic. That is exactly why we developed Paid to serve as the definitive B2B settlement infrastructure. And given these structural market shifts, we expect its penetration to accelerate significantly. Our strategy for expanding the customer base centers on generating recognition and customer inflow through targeted online marketing. This includes diversifying our approach through a combination of SEO, listings, participation in exhibitions, and other measures. Concurrently, we are stepping up our outbound efforts by expanding our sales force, generating direct customer inflow through field activation. We are also working to maximize partner ecosystems, such as agencies and in the area of sales outsourcing. Furthermore, to drive wider usage and increase both ARPU and LTV, we are focused on boosting the rate of paid usage among our existing customers. We will accomplish this by strengthening our customer success structure, which includes developing robust onboarding and follow-up structures, as well as offering dedicated sales promotions and functions to our top-tier customers. At the same time, we are enhancing our core service functions to improve usability through seamless integration with various IT and CRM tools, simplifying the registration process and strengthening fraud prevention measures. Moving on to the numbers for paid. Our target for transaction volume in fiscal year 2029 is 87.818 billion yen, representing a CAGR of 23.6%. We project 2.112 billion yen in net sales, an increase of 23.9%. Let's now look at Uriho within the financial business. If we break down Uriho's net sales structure, it equals the guarantee balance multiplied by the rates. The guarantee balance itself is the number of registered companies multiplied by the guarantee amount. Consequently, expanding our customer base remains central to our strategy here as well. Comparing a world with and without Uriho, the fundamental issue of receivables guarantee remains the same. It is devastating if a business partner goes bankrupt. However, unlike in the past, we are now in an era where companies must do business with partners they have never met face-to-face. Uriho allows us to provide a reliable guarantee against this risk. While Japanese business culture is traditionally built on a foundation of mutual trust, the landscape overseas is completely different. Receivables guarantees evolved long ago and have achieved incredibly high market penetration abroad. Today, this is a massive global industry, with several major players operating on a truly international scale. Frankly, large corporations in Japan rarely need this kind of service. When a major prime-listed corporation places an order, securing a guarantee is rarely top of mind. Maybe some businesses obtain a guarantee as a matter of routine that I do not know, but the true credit risk remains concentrated among micro, small, and medium-sized enterprises, particularly unfamiliar partners without a database entry and no credit scores. That is precisely why we stepped in to fill this gap. Since managing these smaller accounts through traditional field sales would be entirely unprofitable, we developed a fully web-based, subscription-based receivables guarantee model. This is a business tailored specifically for the internet. As we grow our customer base, our goal is to ultimately make credit management operations a standard practice, rather than something special for everyday SMEs. In a world without Uriho, risk management is entirely post-incident. Companies panic only after a bankruptcy or uncollected receivables arise. One can attempt to send demand letters or make collection calls, but the reality is that debt recovery is virtually impossible once an insolvent partner lacks the capital to pay. With Uriho, we mitigate these losses through the collective pool of our subscription guarantee fees. More importantly, as experts, we proactively manage risk by screening credit limits to determine trading safety in the first place, allowing companies to outsource their entire credit assessment. Given our proprietary data assets and credit know-how spanning approximately 600,000 companies, we are uniquely positioned to deliver vastly superior outcomes compared to person-dependent assessments rooted purely in intuition and experience. Allow me to share with you our strategy for Uriho. To expand our base, we will increase recognition and generate customer inflow through online marketing. This includes increasing recognition by diversifying our advertising methods through listing and placing ads on industry-specific media. We will also step up outbound sales with an increased sales force, strengthen our existing sales teams, and maximize our partner ecosystems. Last is Uriho Mini, our receivables guarantee service for businesses with low annual sales, which launched today. As I noted earlier, Since large corporations are not our primary focus, micro, small, and medium-sized enterprises represent our most critical target demographic. We created this introductory service to prioritize getting these small or newly established companies to use our platform first. Through this framework, users can perform an initial credit check on potential business partners using our BizCheck function. If the system confirms a high level of safety, businesses can proceed with the transaction immediately. Ultimately, these introductory tools allow customers to seamlessly safeguard their corporate activities as they scale, giving them a clear path forward, whether they are turning to Uriho Mini to secure a flagged risk or declining a transaction entirely when the system signals a critical red flag. To drive wider usage, we will focus on expanding both ARPU and LTV by improving service usability to increase the value of transactions per customer. This strategy includes providing fast responses through automated assessment and granting appropriate credit limits using AI. While introductory services like BizCheck and Uriho Mini serve as our primary customer acquisition channels, our ultimate goal is to seamlessly transition these users to the full services of the core Uriho platform. For Uriho, we project 2.324 billion yen in net sales for fiscal year 2029, representing a CAGR of 14.1%. Isolating our core web-based subscriptions from our traditional on-site estimate transactions gives a clearer picture of our digital momentum. For the Uriho subscription segment alone, we project 1.65 billion yen in net sales by the final year of our plan in fiscal year 2029, representing an accelerated CAGR of 20.9%. Finally, we aim to reach 3,158 monthly subscription customers, reflecting a CAGR of 22.6%. To accelerate the realization of the Raccoon B2B network, we will create new services that expand beyond our existing business lines, drawing on both quantitative data analysis and proposals from employees who are in contact with customer needs. We will actively pursue business and capital alliances to offer high-value solutions to our 600,000 group customers, while aggressively considering M&A to maximize value through deep integration. We identify promising services based on the specific challenges facing our target base, which is predominantly SMEs, startups, manufacturers, retailers, and EC or SaaS providers. We focus specifically on sectors with high unit prices and low profit margins, and work to offer services to boost efficiency and streamline processes in these industries. The key challenges we aim to address include customer acquisition, human resources, including recruitment and training, cash flow management, BPO-related issues, and DX, including the utilization of generative AI. We score potential new services against two main criteria: market potential and compatibility with our network. To determine market potential, we evaluate market size, growth potential, industry profitability, entry barriers, and the competitive environment. To ensure compatibility, we assess vision alignment, cross-selling potential, the potential for increasing the group's new customers, and the enhancement of existing service functions. Moving forward, we are actively engaging in proactive sourcing activities to identify target companies across all three execution paths: in-house development, strategic alliances, and M&A. Creating these services will generate 4 distinct synergies, starting with vision achievement, as we automate and streamline infrastructure to make the corporate activities of SMEs more efficient. Second is cross-selling, which transitions our network to a many-to-many trading model, creating an ecosystem where entering any single service allows customers to easily and conveniently utilize multiple group offerings. Additionally, by expanding into new domain services targeting SMBs, partnering with companies that hold established customer bases will significantly accelerate our growth. For example, if a partner serving 10,000 companies joins our ecosystem, we can rapidly expand that customer base to 30,000 or even 50,000 companies within our network. Finally, we plan to drive the continuous enhancement of existing service functions by ensuring that each of our current offerings receives ongoing upgrades. This summarizes the expected synergies for this segment. Addressing our cash allocation, we project cash flows from operating activities of approximately 3 billion yen, supported by 5.7 billion yen in cash on hand and a credit facility limit of 7.95 billion yen. We plan to allocate approximately 3 billion yen to M&A and other investments, alongside 2 billion yen designated for future growth investments. With respect to shareholder returns, we maintain a target dividend payout ratio of 45 to 50%. Concurrently, we will pursue the flexible execution of share repurchases based on market conditions, while allocating approximately 450 million yen to cover shareholder benefit costs. To ensure liquidity, we will maintain 3 to 4 billion yen in cash on hand and utilize our credit facility as needed. Breaking down these future growth investments, we are allocating approximately 1.4 billion yen to marketing-related expenses, approximately 200 million yen to B2B network infrastructure, and approximately 400 million yen to personnel and development expenses. Circling back to Mr. Kono's explanation, we have implemented key changes to our dividend policy by introducing a progressive structure alongside a profit-linked additional dividend. Under this progressive dividend policy, we guarantee a floor of no less than 22 yen per share. As our basic policy, a consolidated dividend payout ratio of 45 to 50% will apply to net income up to 1.2 billion yen. For earnings above this baseline, our profit-linked additional dividend distributes the surplus of profit in stages, applying a 60% payout ratio to the portion of net income exceeding 1.2 billion yen, up to 1.5 billion yen, and an additional payout ratio of 70% to the portion of net income exceeding 1.5 billion yen. This concludes today's presentation.